those who agree that the deficit will always grow are going to say nothing stops this train. Based on the numbers, the train has long since stopped, right? You add up tariffs and big, beautiful bill, the train has stopped. In fact, it's going in reverse. For now, my fiscal impulse is clearly contractionary. There's no way around it. The only thing that would change my view on fiscal is...
This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF, ticker SMHX, later in the show. The Blockworks Digital Asset Summit, crypto's premier institutional event, is back in London this October 13th to 15th. You've got top speakers from BlackRock, Circle, Coinbase, the UK Parliament, and Athena, all under one roof. I'll be there as well, hosting a live forward guidance episode with Quinn and a few others. So if you want to see us record in the flesh or meet some of the other legends from the forward guidance community, this is your shot. Notable macro names like Michael Howell of Cross Border Capital and Jeff Park are already confirmed, with more coming. There's also a VIP dinner on the 13th that will sell out fast. That's for speakers and VIP ticket holders only. It's at Old Billingsgate in London. Use code FORWARD100 for £100 off. See you there. Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another episode of Forward Guidance. And joining me again this week is Andy Constan of Dan Spring Advisors, regular guest on Forward Guidance. Andy, as always, great to have you on the show. What's going on?
How are you? Great to see you.
Great to see you as well. Yeah, no shortage of things to talk about. A lot happened last week and feels like we're just kind of picking up the pieces and figuring out where we go from here. So yeah, I want to frame up this conversation through what feels like three important levers that we'll deep dive into each of them and then start to unpack how to think about the confluence of all three. So obviously there's the Fed and what's going on over there. There's Treasury and QRA policy and what Scott Bessent is doing in that lever. And then there's this fiscal impulse as well of the big, beautiful bill that's passed, and then trying to understand how much of that gets offset by this tariff dynamic. So we'll get into all three, but I want to start off the conversation with the Fed, with that being top of mind. We're recording here on Tuesday, August 5th, just after the July meeting. And we got two dissents for the first time in 30 years. And it feels like we're definitely at a crossroads here. There's a lot of cross currents of just questioning Fed independence. We had Governor Kugler, who resigned early. The plan was for her term to end in January, and she actually resigned just last week on Friday. So a lot to think about there. So just want to get a high-level analysis of what were your expectations going into that meeting, and how did it occur versus those expectations?
Oh, the meeting came in exactly as I think I and everybody else expected, which is they didn't cut, and they basically recognized slight slowing while also not really advocating for anything like a cut with any degree of certainty in September. I would say it came away a bit hawkish when it actually dropped. Powell seems patient. He tilted the Bowman and Waller dissents as, I think in a good way, in that, these Fed governors and Fed presidents tell you what they think. Some may say a little too frequently. And they are constantly telling you what they think. And certainly Chris Waller was very, very clear he was going to vote for a cut. So the dissent wasn't a big surprise. I think Bowman was pretty clear she was going to cut for a dissent as well. And I like the way he framed it, which is this is a committee of people who don't know, aren't certain, and are in the midst of a real discussion. And I think that's appropriate given the circumstances at the moment.
Do you see any sort of signal in that Kugler skipped that meeting and then resigned early? Is there anything to read there in terms of
I
just
don't
narrative?
know. I mean, I'd like to think it was all innocent, and I don't know, but conspiracies are going to be theorized. It certainly didn't matter for the outcome. She was a strong hawk. She was definitely in the no cut camp on the dots. So they didn't need her to do what they did. God forbid it's actually something personal and around her health. But what I'm pleased about is that I'm tired, and I think the market is tired, and I think it does nobody any good to have the next governor, which was going to be Kugler's replacement, and who is likely to be the Fed chair, named as soon as possible. And now that can actually happen and is likely to happen this week. And so I think it's a great outcome that she resigned early. I hope it's not for unfortunate personal circumstances. And I don't think there's any conspiracy. But if I were Powell, I'd rather know than not know at this stage. And I'm sure people like Chris Waller, who's one of the real candidates for the job, would like to know. So looking forward, I think we get a name. And then the way I think about that is it's going to be an interesting dynamic. You've got a president asking you to serve, which in general should be all it takes. But the job may not be well defined. You may just be a governor. You may not be the next Fed chair. And so whomever they name for the governor, presumably there's some conversation that has to exist with, hey, am I going to be Fed chair? In terms of them thinking about taking the job. Again, I think they'll mostly lean on the classic thing. I intend to, serve at the president's will. But it is a 12-year term, and it's a pretty meaningful commitment. And I imagine all of the potential candidates, Warsh, the Kevins, Besson seems to be out of the running. I don't know. Trump mentioned a fourth. I don't know who that is. And Waller, who are the obvious three, are probably going to want to know that they're the chair. But if you name the chair while naming for one, you have a little bit more complicated confirmation hearing. If you don't name the chair, you have a longer, unusual, multiple confirmation processes. And if you name someone who is destined to be the chair, gets a wink and a nod, or gets an actual announcement, Chris Waller's going to be modestly disappointed, I suspect. He's definitely a good man for the job and qualified for the job and clearly, I think, wants the job. And so if he is not named, I don't know. If I were him, I'd probably resign, but I don't think he will. But he's one of two Republicans that could get the chair. He's not going to get the chair. Not that it matters, but 5 years from now, he's not going to get the chair on a Democrat presidency if that happens again. And so maybe he resigns, which I think would have implications to the makeup of the FOMC. So I think it's an interesting dynamic. I haven't gamed it out fully, but I expect that what we get this week is a valid potential chair, but no chair formally announced.
As a market practitioner trying to digest this and quantify this evolution and stair-stepping change in the Federal Reserve monetary policy, the makeup and composition of the committee, you're starting to see some of this start to impact markets. So the SOFR curve has started to speculate on what is the potential outcome in 2026 when Powell's done, depending on who comes into that chair and how much can they convince the rest of the committee and the Senate to confirm them, at least. Like that's step one. But we're starting to see the evolution of these shifts start to impact market pricing. So how do you as a market practitioner digest that, quantify it, and then obviously trade it as well? Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Well, we're talking really about the STIR market, which legitimately is a bet on what the policy rate will be. You can talk about equities, currencies, long-term bonds. There's nothing like the STIR market when you're trying to trade the path of interest rates. And so when I look at what I've heard, there's never been a president that wants higher interest rates, but this one seems to want much, much lower interest rates, like irresponsibly low in my view, but we can come back to that. But much, much lower interest rates. And he's likely to put someone in that is leaning toward, if not willing to guarantee, they will cut interest rates. And so that really talks about two things. One is the path of interest rates that makes sense for the economy, and two, the independence of the Fed. For the former, the market's not really believing that there's going to be a sudden move to lower interest rates after Powell's gone. They aren't. The low rate in the SOFR curve is December 26, which admittedly is after Powell leaves, but it's only a handful of basis points lower than the June SOFR curve. So it's not like there's going to be 100 basis points of cuts made, or the market doesn't expect at least 100 basis points of cuts made the moment Powell leaves the room. So the market's pretty sanguine about whether there is a need for cuts and whether Trump will manufacture much, much lower rates as he seems to desire. And so I think that's interesting. It tells me that there's a lack of belief that he can move not only the chair, but the whole committee. And we could be in a world in which other committee says, no, inflation's too high, or the job market is too strong. We're not cutting rates. And I think the market's saying, okay, there's going to remain some independence, which speaks to why you want independence. You only want, let's just be clear. In a crisis, the Treasury Secretary, the President, and the Federal Reserve Board are 100% aligned. In economic prosperity and economic strength, low and disinflationary or low inflationary economic strength, they're all aligned. It's only in the rare circumstance when inflation has become a meaningful problem and the tackling of inflation is likely to cause economic slowdown and job loss that the Fed and the Treasury and the President are not aligned. So you need that to be true. Markets need that to be true. And that's why they rest on this idea of an independent Fed. But by and large, the Fed isn't independent for very much of it's only independent in very few circumstances. And I don't think we're in that circumstance where we have to worry about a large inflationary influx. So I think everyone's going to be aligned. Rates are going to come down steadily. I think they need to come down faster because I have a view on what the economy is doing, faster than what's priced, but not what Trump wants. Also, as it relates to the Trump desire to lower rates, it seems to be based on some sort of fiscal dominance argument, not in, hey, the economy is weak and it needs stimulus. It's, we want to lower the cost of our interest. And the numbers that he throws around just don't add up. fund $6 trillion in bills that are already, I looked at the 1 year today, it's already trading at a 370 yield at its auction. It's down quite a bit. It's been down since the first set of rate cuts. And so that money's been saved already. And so to get it much lower, let's even say it's another 100 basis points lower, you're only talking about $60 billion of deficit savings. It's not the trillion dollars that we hear Trump say. It's 60 billion. And that assumes that we continue to finance the $2.5 trillion of debt that rolls off, which already has a 2.6% yield. So it's not like there's a lot of room to get it to zero. It's already 2.6. You get it to 2.6, you're not saving any money. So there's just not much the fiscal reason just doesn't hold much water to me. Listen, $60 billion is a nice savings, but it also comes from the economy. It comes from people who are earning that interest and that depend on that interest. And it also may backfire regarding the long-term interest rates that are paid, because we still are financing a $2 trillion deficit with roughly 75%, roughly 75% coupons and 25% bills. And that interest the 2 trillion of new debt matters way more than the 100 basis points of savings if rates are cut. So I think the market's just going to trade based on Trump's desire, fine, but by and large, the way the economic outcomes are. And I think we're slowing, and so we're likely to see lower rates.
Yeah, so we'll get into the slowing thesis in a second, but I think there's a good segue in there into what was some pretty interesting tail possibilities for the QRA that we had, the quarterly funding announcement last week that we had, where there was a possibility, it wasn't a high probability, that based on some of the commentary from Trump and also a little bit about Bessent, that they could look to, on one extreme, issue no long-term coupons in that QRA and just, fund entirely in bills and just wait out until we see the short rate 300 bips lower, and then boom, issue a bunch there. That seemed like it was a possibility. Obviously, that did not happen. So would love to just hear, you had this framework going into that QRA of this potential for a gasoline outcome, which I think I just roughly described. There's this neutral outcome, and then, throwing cold water onto the party that is the economy. What happened there, and what was your read on it?
Well, we got something closer to cold water versus something, anything like gasoline. And the market's pretty much reacted to that. And the reason, so what does it matter? So if the Treasury decided to not issue any coupon bonds, there's a lot of demand for coupon bonds for a variety of reasons. Hey, they issue $1.1 trillion of them every quarter, and some are A+ auctions, some are D- auctions, but they all clear. And so there's 1.1 trillion. Some of that is rolls, people's maturing bonds. They want to reinvest in bonds. Some is new bonds. And there's plenty of demand for bonds. But if you took away the supply, what would happen? All that demand would have to find something. They can't buy bonds. I mean, they could play hot potato and buy some bonds, but the seller would then need to buy bonds. So they can't buy what they need. So they look to buy other things. And that tends to be what QE is about. And so eliminating the supply of bonds is essentially the same as buying a lot of bonds. Reducing the supply is the same as increasing the demand. And so what happens is that creates a suppression of interest rates, long-term interest rates. At the same time, you got to, unlike the Fed, who can print money to buy bonds, the Treasury still needs to finance the deficit, and the deficit they have to issue something, and so they issue bills, and bills are very close to money. They're very close to money because if you want money to spend today, and you have a bill, it costs you nothing. And so you don't have any price risk while you own it. So it's very cash-like. Also, people who want to who have bills and want money can also lend their bills, borrow money with their bills as collateral. And bills have 99% of their value as collateral, where bonds have only 92. And so you can actually literally borrow more cash when you pledge bills than you can when you pledge bonds. And so it makes it more money-like. What happens when there's an oversupply of spot money, which is what would happen if they took away bonds and replaced them with bills? Well, quite simply, money would be devalued. There'd be more money.
Would you go as far as calling this money printing, or is that too far?
Again, I think money printing is a very straightforward thing. It's when you finance by issuing paper money or depositing checks that are funded with nothing but from the Treasury, from the Fed, essentially a reserve injection, funded with promises like a platinum coin or something like that. That's real money printing, but it's as close to money printing as you can get. I never use that term. I just say what it is. You got bills instead of bonds. You can convert bills into money a lot more in quantity and a lot more easily than you can when you have bonds. And so what would happen if they had done what this gasoline thing? They would have created more money-like stuff, and that would have been pretty devastating for the dollar against all fiats, and in particular against gold and Bitcoin, probably against Swiss franc and other harder monies. But that would have been pretty devastating to the US dollar. It would have been pretty stimulative to the economy as well, because some of the people that wanted bonds would buy stocks, and some of the people that wanted bonds would buy corporate credit, and that corporate credit would get recycled into the economy. But in particular, it would have been pretty bearish for the dollar, and that didn't happen. And I think the markets reacted to that by causing the dollar to rally versus all those things over the last few days.
For the most part, that QRA was either baseline or a little bit of throwing cold water. The one exception is this idea of Treasury buybacks, and the situation around there. I'm trying to figure out the sensitivity and the impact of that, because when you read the surface level, it's like, okay, well, they're going to double the frequency, increase the amount of Treasury buyback specifically on the long end, because they're doing a cash management one and then like a liquidity one where they buy the off the runs. So that amount they're going to be increasing. And how are they funding that? To my understanding, it's mostly through issuing bills and then using that to purchase the long end. Correct me if I'm wrong, but based on that, I'm just trying to understand, like, at what point does that become meaningful? Is it meaningful yet? And what is the impact?
Firstly, the change was less than markets expected. That's why I think it's a bit cold water. The change was only $8 billion per quarter. Firstly, $8 billion is literally nothing. Like nothing. It might as well have been unchanged. If it had been 30 billion, that would have probably been impactful. So then you have to say, well, how impactful? But let's first start by saying, correcting at some level the basic idea, which is if you buy back 8 billion more bonds, you need to fund it. They didn't technically fund it. They don't fund anything with bills or bonds. They fund the government with a selection of bills and bonds. And all government programs, all the deficit, plus this buyback, are funded with all the things that were issued. And so you look at what they issued, and they increased the buyback, but they didn't increase any coupons. So that must mean they must have increased bills. And so but they still funded some of the 8 billion with something other than bills. They funded the whole program with the whole suite of things. But you can think of it as they are issuing bills at 8 billion more bills and buying 8 billion more coupons. And that's a twist, and that's suppressing rates. It's de minimis. But it is in a direction that is not. It is offsetting what is still ongoing QT, right? So let's talk about what the quantities that are flowing through markets right now. There is roughly 20 billion of mortgages that are coming due every month. And so somebody in the real economy is paying off their mortgage and the Fed is getting the money. But somebody else in the economy is funding their paying the money. If they paid it off by selling stocks, somebody else had to buy those stocks. If they paid it off by a refinance, somebody else now had to buy that mortgage. So mortgage QT does increase the amount of duration in the markets. That's running at 20 billion. Regular old-fashioned QT is running at 5 billion. So that's 25 billion. That's per month, and you've got 10 billion now, 13 billion of buybacks. And so that's the balance. It's not much. They're in balance with a slight leaning toward QT.
Okay, and so the last potential outcome was we resolved the debt ceiling. Now we're building back up the TGA. So that's happening right now. I just saw today, they're doing a 4-week bills auction for like 100 billion or something like that. So we're in the brunt of it right now, and there was a possibility that they could have lowered their target TGA level from the 850 to something like 750. Obviously, that did not happen. But I would just love to get your read on how is that rebuild going so far? Is it going along with your expectations? Is it going better than expected, worse than expected from a funding perspective? And what's your read on that high level?
It seems slightly on the slow side to me, but not crazy. I mean, if you look at there are 3 Federal Reserve accounts that you care about. There's the TGA level, which is still well below target. I think it's around 400 and it needs to go to 850. And you have the RRP, which is easy money for the Treasury to tap to refill its balances, which is running around 120, 125. But the last bit is so you still have a deficit though. You have 400. You're looking to borrow 450. You have 120 that from the RRP. You still have to get the rest from bank reserves. You have to get to 850 by September 30th if you want to meet target, which is the target they say. They'll get there. It'll be fine. But what will happen is the RRP will go to zero, or close enough to zero so that it's not particularly important. I actually think it's possible that the standing repo facility, which is the opposite thing of the RRP, also starts accumulating some balances, and bank reserves will start shrinking by a few $100 billion. And that's, for now, is not a big deal because reserves are clearly abundant. And it'll only become a big deal if reserves become ample or worse, scarce. And just to get really nerdy about it, banks themselves don't have the same level of reserves. And so you could get a little squeeze on a particular bank whose clients decide to buy a bunch of T-bills and they lose reserves in this refill process. And so the Fed was a little worried about that in that unequal distribution of reserves, and that's why they slowed QT down to so little now. And so we're in that phase. We're in that phase where the RRP ceases to exist, and some amount of bank reserves are used to fund the government. Fund the TGA increasing. And so we'll see how that plays out. It's going fine. I expect it will make it by September, and that'll be a drag on net liquidity for those who like that term.
I'm surprised you said that term, but I appreciate it. Yeah, so obviously the situation now is, we're getting closer and closer to that like lowest comfortable level of reserves. I think it was Waller said it was like he views it as like 2.7 ish, but obviously it's very unequal the level of reserves, so it's hard to get a good read.
And they don't really know.
Right. So they don't really know. It's a rough gauge, but the path seems that we're getting close to that, and then we get to this inflection where they start to to expand reserves in line with GDP growth. And what's interesting, circling back a bit to what we talked about with the Fed meeting, is in the lead up to that, we've seen a lot of talk about their plan for this transition towards what's next. What does reinvestment look like? What does their balance sheet look like? And then we get to the Fed meeting, and nobody says anything about it. Nobody at the press conference even asked about it. I don't know why, but yeah, what's this next regime look like? And is there even anything to speculate on at this point?
You're teeing me up too easily because you know that this is stuff I've been on for years now.
Yeah. Using a similar philosophy to SMH, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHXFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
The reinvestment policy is not QE in that they're really just refinancing debt the money that they otherwise were lending the world, the Treasury. So it's not technically QE, but it also does something that causes their balance sheet to extend in duration. And that shields the private sector, all else being equal, that shields the private sector from absorbing duration that the Treasury would otherwise have to sell publicly. And so the change in reinvestment policy is something that, gosh, I've been waiting. It's a waiting for Godot thing every month. It's supposed to show up, doesn't show up. The only time we heard about it was when Waller made some speeches, Hammack made some speeches, Logan made some speeches. Musalam has also mentioned it. Schmid has mentioned it. And in January, at the FOMC meeting, enough of them were concerned about it that they mentioned it in the minutes. But there's been no plan. Now, that might be something to do with the 5-year review, which we still has not been announced. That framework review is mostly focused on the tweaks to inflation targeting. They had this averaging concept, which I don't think anyone likes anymore, and now they're going to probably have a more hard target, which will still be 2%, but won't have this averaging nonsense. But they haven't really done it. They've only, I would say, 30% of the governors and presidents have mentioned anything about the long-term balance sheet. And the long-term balance sheet looks to be something like, we've got about $2 trillion of currency in circulation, which is perpetual maturity. It never matures and pays no interest. So you need a balance sheet to hedge that. And we have bank reserves, which are roughly $3 trillion. And bank reserves pay overnight rates and have zero duration. And so if you want to asset liability match, you own $3 trillion of bills and $2 trillion of this thing that hedges currency. The thing that hedges currency, it's been argued that could be extremely long-term bonds. I don't happen to agree with that argument, but it is an argument that's being made by scholars at the Fed. And I get it. It's a infinite duration currency in circulation, so why not hedge it with infinite duration? The problem is the infinite duration thing we have marks to market, and the Fed technically has mark-to-market losses, which they never book. So there's an argument either way. But they also don't have to do anything because they already have $2 trillion of long-duration assets that they can't get rid of, called mortgages. What that means is they have the rest of their portfolio. They've got the $2 trillion of mortgages. They'd love to get rid of them, but they can't sell them because they're worried about disruption, which may or may not be true, meaning may or not be disruptive. But they've got them, and they're not going anywhere because they're all low coupons. Nobody's prepaying those things. Nobody's refining those things until interest rates are dramatically lower. And so you have that, the mortgages hedging the currency. And so what you have left is $3 trillion of reserves being hedged with, they've got $1 trillion worth of bonds that are 10 years in maturity and longer that make no sense to anybody, scholars or the Fed, governors that care about this stuff, to own. They can't get rid of those either without selling them. But the problem with the reinvestment policy is they keep buying more of them. Like, stop digging. You don't want these things. You want less of these things. Stop buying them. And that's the whole point. And that's the whole.
And what you're referring to is basically they're extending their weighted average maturity through their decisions, right?
Yeah.
In the auctions.
They're buying duration that is long. So the reinvestment policy works very simple. Whatever the Treasury says sells, we're going to buy exactly what they sell proportionally to our quantity. So if they sell 10 twos and or 100 twos and 10 30s, we're going to buy, and we need to buy 3, or let's say we need to buy 11, we're going to buy 10 twos and 1 30. And so whatever the Treasury says, we're going to do. That's the way the reinvestment policy does. Now, the Treasury also sells bills, which the Fed doesn't buy for this particular reinvestment policy. So by definition, they end up buying more. So the bills get sold to the public, the bonds get sold to the public, but the Fed also buys long-term bonds. So the duration is longer than what the Treasury sells. And so that is essentially shields the private sector from this bonds. And so what happens is their duration extends. And that's what's been happening. And so they can say, no, let's not do that anymore. And that's the change in the reinvestment policy that we're all thinking may come, but has yet to come. And it should be, what that does is it means that the Treasury now has to say, I can't sell as many long-term bonds. And if I don't sell long-term bonds to the Fed, that means if I don't sell them to the public, I'm going to be terming in my debt. And they may say they're already under pressure to not to term out their debt. They may say, "Ooh, we're going to have to start issuing more on the back end in the private sector." So far, they've shown no willingness to increase coupons, but that would be a stimulus if the Fed were to change its reinvestment policy. And perhaps, even though Waller is again angling for the job, he's been the most vocal about doing this reinvestment policy change. Perhaps there's political elements that are saying, let's leave the balance sheet alone and just keep doing what we're doing instead of making a change that is contra to what President Trump wants. Like that would be aggro.
That makes sense. Okay, so last big lever before we get to the confluence of these into your growth outlook, but we're trying to figure out the fiscal impulse. So we've had the big beautiful bill passed now, and depending on whose budget scoring you use, whether it's the CBO or the CEA, let's call it that we're at a 7% of GDP fiscal deficit, and without consideration of tariffs, maybe we would get to 7.5, 8. But like I mentioned, in a lot of these scorings, they don't consider the tariff revenue, which I find very perplexing. So there's this baseline assumption that, okay, even though there's these notions of Doge and some versions of austerity, we're actually going to increase the deficit with the big beautiful bill. But then there's this other outlier factor of, okay, well, now we're getting annualized, I don't know, $400 billion a year of tariff revenue. That's a tax. And it's not getting incorporated into some of those forecasts. So what is your read on the fiscal impulse at this juncture?
Right. So firstly, the reason why it's not getting scored by SIBO is it's not the law. There is no law. There is an executive order that is declaring deals and collections are being made. That may get struck down. That's a different topic. Happy to talk about it. But it's not law, so no one that is responsible for describing the law can actually estimate it. But guys like Don Schneider at Piper, who's my favorite Twitter guy on this particular topic, does great work that really lays out exactly what's happening and includes tariffs. Prior to tariffs, the big beautiful bill was scored, and Besant says, hey, you should score it with higher real growth because we're going to do all these things that are promoting real growth while ignoring immigration as a negative to real growth, while ignoring tariffs as a tax. We're going to grow higher. So, this is really a conservative view. Whatever. I'm not going to get in that. They pick 1.8, 1.9% for 10-year growth. Why? Because that's what trend growth is. That's what our long-term population and productivity increase is. And anything that promotes growth short-term is typically debt financed or austerity, whatever that might be. So they score it, and the scoring shows that it's a mild fiscal impulse in the balance of 2025, which ends in 2 months, and a mild, somewhat stronger fiscal impulse that goes through 2026. And then from then on, it's a fixed fiscal contraction if the law is then not changed, which of course it could be. Those who agree, and I'm one of them for 40 years now, those who agree that the deficit will always grow are going to say nothing stops this train. And of course, the deficit's going to grow in the back half. But the law says it's going to start contracting in 2027. So that's that. Add on 400 billion, add on 1.5% of GDP of tariffs, you got a recession. Unless, miraculously, the recession happens in China, where they absorb all of the tariff cost. Right? If we don't have to pay the cost, it's not going to affect our consumption at all. But if we do have to pay the cost, it's going to affect our consumption. And so, yeah, sure, you could come up with recessionary scenarios, or you could come up with nothing as the fiscal contraction impulse. If you come up with nothing, you're left with the big, beautiful bill, which is mildly expansionary in 2026. If you say corporations suck, so there's 3 places that this can happen. There's the export supply chain, the import supply chain, and the end consumer. Those 3 are who pay. There's nobody else. It can be interesting in the way you aggregate it when you change the currency, but those 3 pay. By the way, the currency means at this stage is more likely that we're paying than the exporters paying. But we're going to pay. Our corporations are going to pay. They're going to try to pass on the tax to consumers, and the consumers are going to take some of it. And so that's going to be a pretty meaningful contractionary impulse starting already, until they are legally struck down and Trump gives up, or legally allowed and Trump gives up because he thinks it's time to end tariffs. But for now, my fiscal impulse is clearly contractionary. There's no way around it. The only thing that would change my view on fiscal is currently yet to be announced industrial deregulation. That's been a promise. That's been a major promise. They've used some gimmicks around SLR reform for banks, but that's pushing on a string. You need to deregulate. If you're going to deregulate, you need to deregulate the people that are pulling the string. And those are the companies that benefit from deregulation, that build new plants because clean water is forfeited, or don't have to pay as many inspectors, so because we've relaxed what our food supply needs to be, or medicine, or whatever it might be. If we're overregulated, great. That means we save the money without hurting the various people and the environment and the ecosystem and all that regulation is designed to protect. If we're overregulated, great. That's a pure win. And it's been promised. It just hasn't yet been delivered.
We have a Fed that is slow to move. We have a Treasury QRA that is more likely to throw cold water than gasoline. We have a fiscal impulse that is mildly expansive, but likely to be offset by tariffs if what we see as right now being conceded and extrapolated, and there's no overturns by the Supreme Court. Putting that all together, how do you think about that in terms of this, in terms of tracking it through the sequence of data? Because that's where it's been, I feel like, a little bit perplexing. Like maybe we've seen hints of some price level increases in core goods inflation. We obviously had the jobs report last week, which felt like it rocked a lot of narratives. But yeah, how do you expect and how are you tracking this sequence of data as it starts to digest all of this?
Yeah, I'm just going to tell you. I think there's a ginormous industry that spends its time looking at micro data as it's released, and that's not me. Um, I use long-term historical data. I constantly am using historical data, data that has happened to tune my outlook for the economy. Meaning, if today I want to know what the future is, I need to know, well, 10 years ago, when the picture looked like this, how did the data evolve over the next half year? Because that's what I really care about, how it's going to evolve. And so I use that data to tune my outlook. Today's data isn't worth anything to me. All it says is, okay, one day in the future, I'll be using that data for historical data purposes. But it's widely expected, analyzed by, again, a legion of people. It's messy and noisy, as we've seen, and it's subject to all sorts of odd behavior, particularly. So there's the hard data, which gets, I mean, we saw this GDP now thing, right? It went to negative 2.5 because they had a mistake on gold inventories. But it turned out it was pretty damn light because imports just went through the roof in the first quarter as people front ran tariffs, which, not surprisingly, is now that there isn't, now we've already imported ahead
We're
too
seeing
much.
the opposite. Yeah.
It's going the opposite way. And
Yeah.
so and so that's one thing. The other thing is sentiment data, which is a combination, which has all manner of issues, but the primary one I'm focused on is that it tends to be heavily impacted by sentiment, which is heavily impacted by markets. So you're more likely to get hot data after a strong equity market performance, and you're more likely to get soft data after a week. So that has its own interesting dilemmas. And then you have this whole accuracy thing, and Ray said it right. This shit is antiquated. Fix it. That makes all the sense in the world. Now, that said, would I have chosen to fix it when the number didn't happen to go my way and fire the guy then?
Rough timing.
It's not the way I would do it, because next time the data is reported, if it's good, no one's going to believe it. And if it's bad, people are going to say, holy fuck, you were manipulating it and it's bad. Even if he doesn't manipulate it, even if it's totally honest.
Yeah, it's
So,
been demasked at this point.
so I wish I could say that I care much about data. I just feel like, of all the people that you're going to interview, I can get in the weeds if you want, but man, I think you're missing the picture if you spend time in the weeds. What you need to do is think about the big macro forces at place and what's priced in. And the big macro forces at place are a probably multi-year secular shift out of from heavily overweight US assets in the global portfolio to less overweight, a slowdown driven by fiscal contraction. And those are the big, and an equity market that is fairly optimistically priced given that backdrop. In terms of rates, you've got this other big thing, which is deficits are not coming down. So there's still tremendous amount of supply that needs to get sold, and both the Treasury and the Fed are irresponsibly long duration and need to term out. That to me is a secular issue that means that long-term bonds are just less buyable than short-term bonds because they have this overhang of meaningful supply. And you see that bonds can't get placed. So they end up in levered hands that are charging more and more spread through the swap spread market, such that for people for them to hold the bonds. And so that is, to me, the big things that are going on. Throw in AI, throw in the ebbs and flows of what to me in the United States seems to be debasement oriented actions. And those are the big things I'm focusing on. And how they end up playing through in the data are, a year from now, I will have confirmed myself that I thought a slowdown was coming. But last week didn't make me think that the slowdown was coming any sooner, even though the data made it look like it was a slowdown was like imminent. No, it's just got to play through.
Yeah, I think that's good advice. I mean, like like you can get caught up so easily in the weeds of this data, and then you just get whipsawed in every direction. So, I mean, you're still tracking what sounds like a sequence of events. It's just from a 10,000-foot view instead of a 10-foot view.
Well, and confirmed over time with long histories of how it all works. Like my 10,000 view is built off of 10-foot data for long histories. It's not, it's not vibes.
Yeah, totally. Yeah.
And I could be wrong. Listen, I could be wrong. The economy, there's actually quite a bit of, so for long periods of time, for pretty much every time since I've been online, and certainly since damp spring, I think the idea that financial conditions drive the economy instead of short rates has been a core focus of mine. And listen, we're up a lot from where we were in April. Not much versus where we were in January, but up a lot versus where we were in April. And so there's a financial conditions easing that could be enough to offset all these other factors, which is, as I said, a heavily contractionary fiscal stimulus. Maybe it's enough, and animal spirits allow keep the equity market elevated, which keeps spending elevated, which keeps this economy going, and which brings jobs back higher. That could happen.
The vibes, to put it one way, of the last couple of months has just been these tenets of run it hot, nothing stops this train, devaluation as a key narrative, and we've seen the market reflect that in some way or another. Gold's doing well, Bitcoin's been doing well, equity's back at all-time high, bonds in the gutter. So I just want to get your read on how do you look at the price action based off that and understand how much of it has been discounted? Because it feels like, just using the lens of the big beautiful bill, where going into it was like, all right, we've gotten this pivot from Doge to nothing stops this train. But what you're saying is that in reality, it's a lot more nuanced than that. But I don't really see a lot of nuance in those conversations around those.
Yeah, I mean, based on the numbers, the train has long since stopped. Right? You add up tariffs and big beautiful bill, the train has stopped. In fact, it's going in reverse. But that doesn't mean market pricing does that. And listen, I loved them. I hated them in January. Equities, crypto, gold, not gold, crypto, bonds at some level. Loved them at the bottom. Hated them on the way well before the top. And it's hard. It's hard. I didn't expect the momentum that has driven markets to carry through as much. And it seems to be, I hate to, it's always much more nuanced than this, but it doesn't seem to be an institutional chase. It seems to be a do-it-yourselfer chase, self-directed chase, retail chase, whatever you want to call it, into more speculative assets, which to me suggests that there's either levering up in the private sector or some other stimulus. And it could be the TGA drawdown did something. That was in the midst of it. or it could just be regular old animal spirits. And when I look at the macro conditions, I say, okay, that was a hell of a run. Is there enough to take it to the next level? And in a contractionary fiscal with a central bank that's going to cut rates, but not crazy, isn't going to do QE, isn't going to, may in fact make it worse by doing reinvestment. The Treasury isn't going to do ATI, or at least not for the next 3 months. The TGA is being rebuilt rapidly and will be rebuilt rapidly. I think it's time to rethink what the next few months will be. And also, the debasement trade is not a one-way train. And while it's always going in one direction, the reversals can be pretty sharp. And so I'm bullish the dollar and I'm bearish gold right now. I would say I'm bearish Bitcoin, but I don't take positions in Bitcoin yet. And so just because I'm bearish gold and bullish the dollar, you would think that would mean bearish Bitcoin, and it would. But again, it's not my thing.
That's fair. What about long bonds?
Long bonds, as I said, secularly can't own them. On the other hand, short end, which I own a lot of, that's saved my summer. Short end is going to go lower. Rates are going to go lower on the short end, and they're going to drag long bonds down. But we've gone from 450 to 418 on the 10-year note, and short-term interest rates I think are going to go from a little over 4 down to 345 on the 2-year note, and the 10-year note's probably going to rally to 4%. Assuming the slowdown continues. Listen, we get a crazy inflation number, and the accurate jobs number, whether that's reported by the government or determined by others, is strong. We're going to go back up in yields, but for now, I think it's okay. I just would rather own 2s through 5s, even levered, than own 10s and 30s, which have this secular supply problem.
Yeah, I think that's super fair. There's something in there that's really interesting, just sparked a question I have. But this idea of how does, just pricing up the long end in terms of how much does it discount the short rate? Because obviously we've been going through this discussion of, okay, if we cut the Fed funds, is that going to lower mortgage rates? Intuitively, it's like those are separate worlds. But there is this like residual of the long end being somewhat priced off like a present value of the Fed funds to think about. So like, yeah, what's the right way to think about that pricing?
So I start with term premium. And when term premiums are wide, I care about the long end more than the short end. Right now, they're not particularly wide. They're not as wide as they were this winter. So they're less attractive to me. And then there's just the general steep curve. Most of my career, most investors, particularly banks, but hedge funds, pretty much everybody, did what was the greatest trade in the world, which is ride the curve. Finance in short rates and buy long rates and pick up spread. You could, because the curve was positively sloped. It's not even positively sloped right now. We've got an overnight rate of 433, and except for the 30-year, nothing on the curve has positive carry. Everyone is, if you finance overnight and you buy a levered position in a coupon bond, you're not getting enough interest to cover your carry. And so where I really want to own bonds is when the term premium is wider and you can get real positive carry on bonds. And so how much is that? If we get to a 3% 2-year note, I think you're probably going to get quite a bit of demand for 4% 10 years. Mm-hmm. But you're not going to get demand at 3.5%.
All right. So last question here is sort of ties into a lot of different things we talk about, but this idea of stablecoins as being a marginal buyer of debt. I keep asking guests, and like you've been doing some actually great research into this and just an explanation of where does the marginal bid for stablecoins come from, and how does that interplay with the debt that backs those stablecoins? And so I'm just going to open it up to you. I would love for you to just use this moment to explain to my audience, which is probably going to be somewhat crypto savvy, but also very macro heavy. We're all trying to figure out the net impact of stablecoins on being a marginal buyer of T-bills. What is it?
Okay. Caught me by surprise on this one, but I'll
I was just like, I have to ask you it before
there
we
are
go.
two things. The way I break it down. Listen, I don't know shit. I'm a 61-year-old. I'm calling myself Gen X. You're going to call me a fucking boomer. All I'm doing is trying to make sense of the world. What makes sense to me is there are methods of payment and there are stores of value, or what I would call savings, like cash savings, not investing, cash savings. And we all know what those things are. We can use currency, physical bills to buy shit, or we could Zelle some of it, or we could write a check, or we could have auto pay ACH, or we could pay by credit card and then pay off our credit card, or we could use Venmo, or any means of commerce. Back in the day, I heard that Bitcoin was going to be a payment rail. And that seems to be no longer part of the narrative, that Bitcoin is firmly in the, that no one transacts in Bitcoin, that they convert to stable coins and then transact, or convert to physical dollars and then transact. So I look at the payment rails and say, is the US a place where the payment rail system is broken? And I don't think so. I could be wrong, but people who lived and died using Venmo are using it less. Credit card backed things like Apple Pay or Stripe or PayPal or any of these sort of ways of, it's just really just a GUI for transacting with a credit card. They save it. So people pay by check, people Zelle, people pay physical cash, people ACH, people Venmo. Pretty much everybody's needs is satisfied. And if you really need to do a big transaction, you can use a terrible system called a bank wire. But that's the US. So is there a disruption opportunity in the United States? I don't know. But it could be. But what it would require is, like, people will say, well, if they let me spend stable coins for my goods and services, I would do that. That they may. But is your employer going to pay you in stable coin? That one seems to be much trickier. Like, your employer is entrenched in banks, and he's going to do a direct deposit in your bank account. And then you have to do the transfer into a stable coin. So I don't know what the long term is, but that's payment plan. As a US person, from a savings standpoint, I want to break it down between Genius Act compliant stablecoins, which are not Tether, fully backed T-bill stablecoins, are riskless and legally can't pay interest. And when I say that, people are say, well, I'm getting interest. And no, you're not. Coinbase is paying you an incentive to hold stablecoins. It's a bonus. It's a teaser. It's like when Visa says, hey, I'll pay you 1.5% cash back. That is an interest. Okay. So while it's nice to get these teasers, that's not the same as interest. And so to me, I look to a checking account as a comparison to a stable coin and say, what do people do with checking accounts? And do they keep money in their checking account earning zero interest? Or do they keep the minimum amount of money possible in their checking account and keep the rest in savings accounts and money markets that could easily, instantaneously be transferred to the checking account? I think they do the latter, not the former. But there's some money that sits in checkable accounts that is a place for stablecoins to disrupt. But that's the limit of it in the United States. Otherwise, why would people put savings in a zero interest account. So anyway, then of course, there's the rest of the world. And the rest of the world, currently at this very second, every person in the world has exactly as much US dollars as they want. How do I know that? Because if they didn't have exactly what they want, they'd do something about it. So they have exactly what they want. Some would say, well, I'm really constrained. I can't have as many dollars as I want because I live in a country where I don't trust the banks. And if I were to go into Argentina, for example, and say, give me a US dollar deposit at my local bank, they'd say, sure. And then the government would take it and devalue it when they wanted to. And so I get that. And then there's a whole cohort that's not banked. And so I get how there is but the thing is about those countries is $1 trillion of Benjamins lie around the world. And there's a secondary market in Benjamins. And you go to every country on earth that has a difficult time with its currency and you pay for something in US dollars, you get more for your money. There's a gray market in dollars that means it's a premium good. And so if somebody said, hey, I really want dollars, they can go and convert their pesos into and own physical Benjamins and pay a premium for them. So that could be a place, that premium could be a place that really gets disintermediated by a stable coin, because people will say, hey, I'd rather keep this thing on my phone than keep it in my bank. People, though I can transact with dollars locally, if I want to, not that a lot of people do this, but if I want to transact globally, I don't know who these people are that are spending all this money cross-border. But yes, they can keep their physical dollars, or they can take those physical dollars and turn them into stable coins. Those physical dollars are real Benjamins are new demand for T-bills. That is a fact. What isn't a fact, and what people get confused about, is non-physical Benjamins. You have pesos and you go into a bank in Argentina and you convert to dollars. Somebody else provides you those, and then you buy a stable coin. Somebody else provides those dollars and is invested in something. And so they have to sell the thing they're invested in so they can give you the dollars and they take the pesos. They sold something, you bought something, net nothing happens. So from a money plumbing standpoint, whether you're in Argentina or New York City, if you want to buy a stable coin, you are taking dollars out of the system, which requires an asset to be sold, such that the stable coin buys an asset at the same time, no net change. So those are the flows. And so I see a world in which there's payment rails are improved. Fine. I see a world in which it's possible that converting physical Benjamins into stable coins happens. That creates new demand. I don't see a world in which people use it as a savings vehicle when they have an alternative savings vehicle. So that doesn't create any growth, except in one very narrow case. There's going to be a certain amount of people who, if stablecoins become what everyone dreams they are, which is a new payment rail, they'll keep some money on their phone, just like they keep a limited amount in their checking account. And they'll do that, just like people who keep a limited amount in their Venmo account. They'll do that. Is that trillions of dollars of new demand? No. What you need for new demand is savings, not a little bit of a minimum amount of money people keep on their phone. And so those are the things the way I added up. And I think stablecoins are going to grow meaningfully, possibly double, maybe even triple over the next 5 to 10 years. But they're not going to generate $2 trillion of net. By the way, that's only like 700 billion. They're not going to, and that's, by the way, huge growth.
Yeah.
They're not going to generate 2 trillion of excess bills demand because the excess bills demand has to come mostly from converting physical currency into T-bills, into stable coins, and there's only 2 trillion of that. And currencies aren't going away as much as people might. People like having physical cash. People value physical cash because it's untraceable.
It feels like so many inaccuracies in the macro world can just be characterized that people forget that for every buyer there's a seller, and for every seller there's a buyer.
It's literally the thing I run into the most in my life when I'm talking about macro is that thing.
So there you go. If there's one thing to keep from that, and I appreciate I threw that at you left field, but I appreciate you catching that and running with it, because I think it's important commentary to add to this as we figure it out. And yeah, I think it's important to remember there is always a counterparty. So I appreciate that. Andy, always really great to get you on the show. Really enjoyed that. Where can folks go if they want to see more of your work?
Dampspring.com for my website, and at Dampspring on Twitter. There all the time.
There you go. Thanks, Andy.
Pleasure, Felix. Thanks for having me.